we are kicking things off with the massive momentum driving Alphabet Inc. Class C stock. This tech giant is absolutely crushing it, fueled by explosive growth in its Google Cloud and cutting-edge AI innovations. We dive into how Alphabet is maintaining its dominant position in the U.S. tech landscape and what this means for your portfolio right now.
Never get caught with a dead phone again. This INIU portable charger is compact, travel-friendly, and gives you fast 45-watt charging with a built-in USB-C cable, so there's no need to carry extra cords. With 10,000 mAh power, it's perfect for busy days, trips, emergencies, or anytime your battery drops too low. Grab yours on Amazon through the link in the comments before your phone hits 1%.
Next up, we look at a major regulatory shakeup coming out of Europe. European officials are preparing to introduce the Tech Sovereignty Package, which could seriously restrict Microsoft, Amazon, and Google from handling sensitive government health, financial, and legal data across the continent. This is a huge development that signals a major shift in how global tech infrastructure operates. But the regulatory battle is heating up because of massive infrastructure deals. We examine how Anthropic is leveraging Google Cloud and Alphabet's custom silicon, hinting at a potential $200 billion commitment to train its Claude models. This story shows exactly how the AI era is reshaping hyperscale infrastructure and who is winning the compute race. Finally, we wrap up with a deep dive into the incredible financial performance of Google Cloud. We see how the company is exploding revenue and profit margins, boasting a staggering backlog over $400 billion, proving the infrastructure flywheel is fully engaged. Don't miss the rest of this essential news update. Alphabet Inc., Class C stock, trading under the GOOG ticker on Nasdaq, is demonstrating robust momentum driven by its strategic focus on artificial intelligence and Google Cloud innovation. As of May 11, 2026, the stock reflects strong investor confidence stemming from diversified revenue streams across search advertising, cloud computing, and emerging AI technologies. Alphabet operates as a multinational technology conglomerate, with its core business rooted in Google services, including search, advertising, and consumer products like Android and YouTube, where targeted advertising remains the primary revenue engine. This segment capitalizes on vast user data for precision marketing. Crucially, Google Cloud Platform is emerging as a high-growth frontier, actively competing with industry giants like Amazon Web Services and Microsoft Azure in the enterprise cloud services market. This cloud expansion is a key driver for Alphabet's growth trajectory. AI advancements, exemplified by models such as Gemini, are permeating the company's ecosystem, enhancing capabilities from search accuracy to cloud analytics. This integration positions Alphabet at the forefront of productivity tools. Beyond core services, the company maintains a diversified portfolio. YouTube's subscription services provide steadily growing recurring revenue, while hardware and other bets, such as Waymo in autonomous driving, offer long-term upside potential. Alphabet's dominance in search, holding over 90% of the U.S. market share, provides significant exposure to the digital economy's backbone. In the competitive tech landscape, Alphabet leverages its scale and data moats to maintain a competitive edge against rivals like Meta and Microsoft. Furthermore, strategic investments in quantum computing and sustainability align the company with long-term industry shifts. For U.S. investors, Alphabet Class C offers direct access to a company integral to the S&P 500. Its growth in cloud services taps into U.S. enterprise digitization, while AI innovations secure its relevance in the productivity sector. Investors are closely monitoring the company's adaptability to evolving regulatory scrutiny and competitive pressures, viewing its diversified structure as a cornerstone for sustained relevance in technology innovation. Europe is poised to significantly restrict major U.S. cloud providers, including Microsoft, Amazon, and Google, from handling sensitive government data across European Union member states. This move is set to be formalized through the upcoming Tech Sovereignty Package, scheduled for presentation on May 27, 2026. The primary driver behind this regulation is concern over the U.S. Cloud Act of 2018, which permits American authorities to compel U.S. companies to hand over data, even when that data is physically stored in European data centers. While the package does not aim to ban American technology companies entirely, it targets the handling of highly sensitive information, pushing for the development of domestic cloud alternatives. This regulatory push is partly motivated by the desire to bootstrap sovereign cloud offerings and enhance digital self-reliance, especially amid the surging demand for cloud computing driven by artificial intelligence. Microsoft has responded by defending its position, asserting that it rejects invalid government requests and requires proper warrants before granting access to content, challenging potential overreach under existing privacy laws. However, European officials point to existing dependency risks. For instance, the UK's Competition Authority has identified that Oz and Microsoft exert significant control over cloud spending through proprietary licensing and data transfer fees, creating vendor lock-in that makes switching providers difficult. The EU's response builds upon existing legislation, such as the Data Act, which mandates switching rights without penalty fees by 2027 and requires standardized APIs to combat vendor lock-in. This signals a fundamental shift in enterprise cloud strategy. Diversification across providers is becoming a regulatory necessity rather than just a redundancy measure. The convenience of hyperscale cloud dominance is facing a significant political reality as global data sovereignty concerns increasingly shape technology policy. The European Commission is preparing to introduce a significant tech sovereignty package later this month, which is poised to restrict major technology giants like Microsoft, Amazon, and Google from processing certain sensitive data belonging to European public sector organizations. According to unnamed Commission officials cited by CNBC, the proposed restrictions will specifically target financial, judicial, and health-related data. A Commission spokesperson characterized the initiative as a measure for Europe to wake up and get its act together. The focus of the package appears to be on public organizations, with private companies retaining the freedom to choose their preferred cloud platforms for proprietary data. The primary target is identified as US-based cloud providers, which currently dominate European public sector cloud workloads. The Commission views this package as a strategic move to bolster European cloud providers and stimulate sovereign cloud options, aiming to create growth opportunities for EU-based companies by attracting institutional users currently dependent on US platforms. Furthermore, the regulatory plans include reforms to public procurement processes to ensure a wider variety of cloud and artificial intelligence service options are available to European public bodies. This tech sovereignty package is being developed concurrently with the Cloud and AI Development Act and the CHIPS Act II, signaling a broader European strategy to decrease dependency on US technology infrastructure. These proposed restrictions represent a more substantial intervention than previous voluntary frameworks and could potentially affect existing contracts held by Microsoft Azure, Amazon Web Services, and Google Cloud with European public sector entities. While the package has not been formally announced, Commission members are currently finalizing the specific details, including the scope of data restrictions, the categories of data involved, the implementation timeline, and provisions for transitioning existing public sector contracts. The EU has yet to comment on how these measures will interact with existing data protection frameworks or with US companies offering EU-based data residency services compliant with GDPR. Anthropic, the artificial intelligence company behind the Claude models, is reportedly deepening its strategic alliance with Google Cloud and Alphabet, signaling a massive infrastructure commitment for the future of AI. Recent reports suggest Anthropic may be entering into a significant $200 billion agreement over 5 years with Google Cloud to secure additional compute capacity and custom chips. This move underscores the intense competition for frontier AI training resources, with Anthropic utilizing a diverse hardware mix, including AWS Trainium, NVIDIA GPUs, and Google's Tensor Processing Units, TPUs. The partnership is already yielding tangible results. In late 2025, Anthropic expanded its footprint with Google Cloud, securing access to up to 1 million TPUs in a deal valued in the tens of billions of dollars, with a goal to bring 1 gigawatt of capacity online this year. More recently, the collaboration intensified by involving Broadcom to secure multiple gigawatts of next-generation TPU capacity, slated to come online by 2027. This commitment validates the potential of TPUs for training cutting-edge models and highlights a broader trend where AI is fundamentally reshaping hyperscale infrastructure deals, with Alphabet positioned at the epicenter. Google Cloud itself is demonstrating explosive growth, transforming into one of Alphabet's fastest-growing and most profitable segments. In the first quarter of 2026, Google Cloud generated $20 billion in revenue, marking a 63% year-over-year increase, and operating income tripled to $6.6 billion, with margins expanding to 33%. A key indicator of this infrastructure flywheel's success is Alphabet's cloud backlog, which has doubled quarter-over-quarter to exceed $460 billion, providing immense revenue visibility. Alphabet is aggressively investing hundreds of billions annually in data centers and custom silicon, while monetizing this capacity through long-term contracts. For long-term investors, Alphabet presents a compelling case. It offers a proven AI-native cloud platform gaining market share, proprietary chips that drive down costs, and a valuation that remains attractive relative to other hyperscalers given its trajectory. Regardless of the specific terms of the Anthropic deal, Alphabet is positioned as a core beneficiary of the accelerating AI build-out, representing ownership in the foundational infrastructure powering the next decade.